You're listening to The Money Hour with your host, Tina Mitchell. Sponsored by Absolute Mortgage, a division of Pinnacle Capital Mortgage Corporation. Now, in the studio, local mortgage and finance expert, Tina Mitchell.
Welcome back to The Money Hour with your host and mortgage expert, Tina Mitchell, right here on 1150 AM KKNW, the July 9th show. I'm dedicated to my listeners, providing you with tools needed to make informed decisions on matters when it affects your money. If you're hearing my show at a different time or day, you are listening to a rebroadcast, but you can call the show at 1-855-400-1150. Again, that's 1-855-400-1150 or online at themoneyhour.com. I can connect you with the guests that I have in studio or answer any questions that you have. Right now in studio with me, I have Gary Cassill with Mountaintop Advisors. We'll be talking on investing in a low interest rate world. Gary, thank you so much for coming back in studio.
Oh, thank you very much, Tina.
And a little bit about Gary. Gary, again, is with Mountaintop Advisors, first licensed in 1984. Gary's been in a high-volume bank program and at a very well-known credit union. He has his Series 663 and Series 7 licenses, in addition to being fully licensed for life insurance and annuities, both fixed and variables. And really excited for our conversation, Gary, to see what's happening in your world right now and sharing with my listeners investing in a low interest rate world. So with interest rates so low, how can an investor find ways to get a decent income from their investment? CDs are horrible right now.
Absolutely. Tina, as your listeners know, it's a great time to borrow money, but it's a very challenging time to try to earn interest on your savings or in safe investments like fixed CDs and bonds and annuities. It's particularly tough on seniors who traditionally rely on these programs for their retirement income. But let's kind of start with the basics. Stocks, bonds, and cash. Those are kind of the traditional investments that people hold in their retirement accounts and their other investment accounts, maybe in their 401k plans or their IRAs. So we've got stocks. Everybody knows stocks have some risk involved, but they're very volatile right now. Mm-hmm. And part of that's because the stock market doesn't like uncertainty, and we've got this huge election, this very highly contested election going on. We had the Brexit over from the EU. Puerto Rico's having a debt crisis, and that's in the news. There's been some terrorist actions, and all of this makes the stock market kind of an uncomfortable place to invest. So there's wild fluctuations in pricing, but very little gains to be shown for all the risk that you tend to be taking. Now, bonds, this is the area that I think could be one of the scariest places to invest. And I hear clients all the time say, well, wait a minute, I thought bonds were safe. Mm-hmm. And that is what most investors think, and they can provide steady income, which is wonderful, but you're likely to see interest rates, as interest rates eventually go up, the values are going to drop in bonds.
Correct.
And so nobody likes looking at their account, even if they want the steady income. They don't like looking at it and seeing their values drop.
Yes.
So if you think of it kind of like the teeter-totter that you played on when you were a kid, one side goes up, the other side goes down. With interest rates on one side going up, the values will go down. Mm-hmm. So, and it's not like they put the fulcrum right in the middle where it's nice and fair. The longer the bonds are, the more they go down. So Morningstar showed a result back in 2003 when the Fed raised interest rates just 1/4%. It ended up dropping values on the safest of bonds, the U.S. Treasuries. It dropped them down over 14% in 2 months. Yep. So that to me is pretty scary. So what do you do? Well, when you've got a situation like this, where you had the bank crisis, and what happened was Dodd-Frank rules came into effect. Banks got more regulated, and what happens? How does that affect investors? One of the things that happens is when their lending practices got highly regulated, they're no longer able to loan as much on commercial property as they used to. Mm-hmm. highly qualified investor buying a commercial building could maybe get 90% financing from the bank. Now he's lucky to get 50, maybe 60%.
Sure.
So there's an opportunity there for somebody to come in and say, I will provide essentially the second mortgage, a mezzanine loan, to cover the difference. So the investor is still only putting 10% of their own money in. The overall blended rate works out pretty effective, but if you're the investor that's putting up the money for them, you get a pretty decent rate of return on that. So that's one area that people can do pretty well on.
So let's talk about that, investing in, commercial real estate for income and value appreciation. How can you do that when the accounts are not worth millions of dollars?
That's a very good question, and I get a lot of my clients are asking me that, like, how can I do that with what I've got in my account? Well, one way to do that is by using real estate investment trusts. They're commonly called REITs. They allow smaller investors to go into these bigger projects. The REIT may own a portfolio of buildings. They may own multiple buildings, and they may have them spread over a big geographic area for further diversification. They may own a couple of different kinds of buildings. Again, to try to provide some diversification. All of that does not ensure gains, and the income isn't guaranteed. But if the programs run well, it can do very well for the investors, often paying 6 or even 8% per year, which is certainly a lot better than 1% that they're getting in CDs, or maybe 2 or 3% that they're getting in bonds.
Sure.
That have that risk of going down.
Okay. So these real estate investment trusts or REITs own lots or buildings and collect the rents. Correct?
Yes.
So how do you know if they're going to send the income my way?
How do we know that they're going to send it? Well, one of the great things for the investor is that REITs are required to disperse at least 90% of their income to the investors, or they lose their tax preferential status. And that would really hurt them a lot. So they're not inclined to do that. Again, every investment's got risks, and the non-traded REITs risk basically is liquidity risk. And what that means is not that you're going to lose money, but that your money is going to be tied up for a while and you can't access it. It may be tied up for 4 years or 5 years, and you have to wait as the investor for that portion of your investments. You can't need it in that period of time. Yeah.
So really analyzing and make sure you understand what you're doing with that money, and you're fine not having it for whatever that period of time is.
Exactly.
So how can you find out the track records, what their track records are, their past investments, to make sure that this is a safer investment?
That's another kind of wonderful thing about REITs. They're required to put their good, bad, and ugly history out there in the prospectus. They have to explain everything that they've done up to this point in REITs, the past performance, and how it went for the investors. Okay.
So would you look at these as safe or risky investments, Gary?
Yes and no.
Okay. Explain that to my listeners.
They're like a lot of investments. There are stocks that are risky and stocks that are very safe. The same thing happens with REITs. There are some of them that they are taking kind of a bold move. For example, they might be buying buildings that are just about to be foreclosed on.
Okay.
The buildings, the tenants have left. They don't have a lot of income coming in. They're not able to make the bank loan. The bank note is in trouble. And these companies might sweep in and buy some of those buildings kind of cheap, but they've got to have the crew, an established crew, to go in there, do a hurry up, quick cleanup job, get new tenants in there. And once they've improved the number of tenants in there and increased the amount of income, then they're in pretty good shape. But meanwhile, they got to buy cheap.
Got it.
So the whole buy low
makes sense. So when you buy low, you've got higher risk. I mean, it's just usually that's what you're gonna see.
But at the same time, there's also some other ones that they're very, very clean, very well run. They've got almost 100% occupancy. They've got very high quality tenants with really long-term leases. So the cautious investor is going to feel very, very comfortable with that.
Of course.
Yeah.
Yep. Makes sense. So what if someone wants to look beyond the U.S. for a good investment options, but just knowing a little bit here in the U.S., probably don't know too much going on in the foreign countries. So is it safe to invest in other countries when it comes to REITs?
It can be.
Okay.
So you have to, the listeners kind of have to keep in mind that about 90% of the Earth's mass is not in the United States.
Yes.
We only have about 8% of the world's population here. So that means that there's probably some opportunities in other places. There's probably some very well-run companies and investments in other places.
Okay.
So that's, I guess, you just keep an open mind on that and do some research, and hopefully an advisor will give you some good advice on where you can go.
Whole other show when it comes to that question.
Yes.
Okay. So have you heard about these impact investing funds, and is this something new?
Yes, that's a relatively new category of investment. And the idea there is that they're not only going to give you a decent return, but they're also going to do something impactful, something beneficial in the community or in the area that they operate in.
Okay.
So one of them that I'm familiar with loans money to small to medium-sized companies in developing countries. They're selected developing countries and very selected companies that they're going to make loans to. These are companies that are in their growth stages. They're profitable. They can afford to borrow money at higher rates. But because of the country that they're in, they don't have banks on every corner like we do around here. We're familiar with having all these community banks for small businesses. They don't have that. Their country may only have 1 or 2 banks total. So nobody's really loaning money to them. And so that gives you an opportunity, if you are in the business of loaning money to businesses, that you can get a decent rate of return.
Okay. All right. So, Gary, what about, most people want a decent return in their IRA so they can hopefully retire someday. And I heard that there's also socially responsible funds do not perform as well. Are the impact funds the same thing?
Yes and no. They purport to make an economic impact in their area or a social impact in their area. So that means that sometimes they are building schools for the employees or the village that they've got their factory in. They might be providing much better housing for their employees and families, and or providing medical care that they don't normally get.
Got it.
So those are some of the impacts that they're doing. A lot of the socially responsible funds just limit themselves to, we're not going to invest in tobacco or firearms or alcohol.
Makes sense. So if they're getting charged a high interest rate, can the companies really afford to pay these loans back?
Well, the very first thing that they look at is, yes, can they afford to make the payments? And then
so
secondly,
there's responsible lending that's going on.
It's very responsible lending. And a lot of times these companies are coming back over and over. They might be using it for trade, where they just need to have a temporary loan while the stuff is in shipment before they get paid.
Got it.
So they're going to come back the following year or the year after that.
Perfect. So what kind of impact do these companies provide to their operating areas, and how do you track them to make sure that they're doing what they've promised?
The one fund that I'm very familiar with, they typically will be expanding employment in their area. These companies typically pay a much higher prevailing wage. So it's very beneficial in the areas that they're operating in. The more employees they have, the better it is for that town or area. Some of the times like I said, they'll build a local school, which is good for everybody. If you've got higher educated, more literate children, then that's good down the road too.
Sure. Gary, I've got 30 seconds, got to take us to a commercial here, a shout out or a call to action for my listeners.
The main thing I would have them do, I think, would be to take a look at the number of bonds or the amount of bonds or bond funds that they've got and be kind of wary. And talk to their financial advisor and say, hey, is this something, tell me about interest rate risk and what are my options?
Wonderful. And you want more information on Gary, just go to themoneyhour.com, type in his name. You can listen to previous segments that he's had right here in studio. A great resource for you to be looking at a diversification and an option for your investments. Gary, thank you so much for joining me in studio.
It's always my pleasure, Tina. Thank you very much.
Coming up next in the Money Hour, coaching buyers and sellers to win in this crazy hot real estate market. I've got Jonna Hood from Windermere Real Estate right here on 1150 AM KKNW after the short break.